If you just stuck with small cap stocks, you would do fine over most time periods, 3, 5, 10-year periods. You would have better returns with higher volatility, better returns than large cap.
On Wealth Track, an exclusive interview with small cap pioneer Chuck Royce.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. There are very few active portfolio managers with more than half a century of experience, let alone one leading the same firm for 50 years and running the same fund, which has beaten its benchmark for just about any multi-year time period you look at. Today's guest is just such a rarity. He is small cap pioneer Chuck Royce, chairman of Royce Investment Partners, which he founded 50 years ago in 1973. Chuck is also a portfolio manager on 4 Royce mutual funds and 3 closed-end funds. He is lead portfolio manager of the flagship Pennsylvania Mutual Fund, which he took over in 1972. Royce is credited with identifying small company stocks as a distinct area of investment before it was even recognized as an asset class with the creation of the Russell 2000 Index. Pennsylvania Mutual Fund has delivered 12% average annualized return since inception and has beaten the small cap universe over the years, including the last 10, 20, 30, and 40-year periods, as well as the more recent 1, 3, and 5-year time frames, where it has trounced its Morningstar small blend category as well. Morningstar gives it a bronze analyst rating for its experienced small cap experts, noting that some funds have marquee managers, others have teams. This one has both. Small cap stocks in general have generated subpar returns in the last 5 years and have underperformed large cap stocks by a wide margin over the last 9. But Royce says based on the historical data, small caps are due for a significant and lasting rebound. And he says history is the best guide to future performance. I asked him what the past is telling him about the future for small cap stocks.
We've been in a very weak period for small caps. In the last 5 years, it's about 3.5%, very low. The last 10 years, the large cap have done a lot better. These things do come in cycles, and I am convinced for a lot of reasons that the next cycle will be small cap. There's kind of a simple observation in these cycles that every cycle, you call it these 10-year cycles, which that's approximately what they are. And by the way, we're right at the 10th year now of a large cap cycle. So
right.
But what has been true in history is the next 10 years has always been different, i.e. a different asset class, i.e. small.
I'm looking at the rebound in the mega cap stocks, once again after being destroyed in 2022 with the excitement about AI, artificial intelligence. And so, kind of here we go again, where the mega cap stocks are like 26% of the market of the S&P 500. So is this one of those situations, and you've seen things like this many times over your 60 years of investing, is this one of those situations that could extend like the large cap outperformance, beyond what it typically would be?
So we're in the 9th, 10th year now. But going back in this concentration aspect that you just mentioned, that's the most fascinating thing. That's only happened a couple of times. The last time was in the internet bubble, but prior to that, it was in the mid-70s, around 75, where there was something called the Nifty 50.
Sure.
Polaroid, IBM, Eastman Kodak,
Xerox,
General Electric, Xerox.
Right.
Guess what? They're not here, most of them. And guess what? As that concentration moment faded, the money clearly went to the non-concentrated stocks, which would include small caps.
Right.
I mean, we have this weird phenomena right now where Apple itself is bigger than the entire small cap space.
Wow.
Isn't that,
Crazy.
how about insane, crazy?
Yes. Yep.
So we are at super concentrated levels. I do believe that's going to pass, and I do believe, in a sense, those highly concentrated stocks will act as the ATM for small stocks. I'm kind of making fun here, but I do think money will flow over to the average stock, which includes small cap stocks. It's happened before, it's going to happen again.
You are a pioneer in the small cap space. You were one of the first to identify small company stocks as a distinct asset class, or an asset class that you were very interested in. How has it changed over the last 50 or 60 years? Have the characteristics of small company stocks changed very much?
Probably the single most important thing, it is now a defined asset class.
Right.
I mean, when I started, I was trying to make money, from stocks of any type, but I was drawn to smaller stocks because they seem to be, and they still are, inefficient. And they're less trafficked, and there's less knowledge. And if you do the work, they can have a better outcome. But there was no such thing as a small cap universe. Russell invented this thing called small cap, and then they went back to 78 and said that's when the index was. Now, the index wasn't available in 78, so it was a little bit of a slight con job about looking back historically. But in truth, we were there the whole time.
So the other thing that's interesting about, your evolution as an investor, I think you told me that when you started at Penn Mutual in 1972, that you didn't start out as a value-oriented investor per se, or a value investor as it's called now. What happened that you became more value-oriented?
I lost way too much money for shareholders in 73 and 74. And the learnings for me is that the risk element, the risk in whatever I'm doing has to be much clearer and much more identified, and I have to be fearful of losing too much money. So the simple rule is, don't lose the money. It became my mantra over time. But that took 2 or 3 years of losing too much money.
How are you becoming risk averse in your portfolios, which you are known for your risk adjusted returns and less volatility than the market, for instance? So how do you do that?
We have no state secrets here. We are very interested in less leverage, the amount of debt. We are very cautious about leverage. We want high returns on capital, very simple number. We want that to be sustainable in most of our products. So it's a combination of focusing on the positive, high returns, and focusing on where companies could get in trouble. Leverage. Leverage has taken down, more companies in the small cap space than probably anything.
The other interesting aspect of the small cap, for instance, the Russell 2000, is that I saw some figures that Royce had in your research that I think 43% of the Russell 2000 companies don't earn any money. That
is true. That hasn't always been that high, but it's at a high right now. That and it's a combination of things. In the small cap space, we have lots of companies who are just starting out, and they use the public markets as a form of financing. So that kind of screws up some of the numbers.
Right.
But it's not where we're looking. People over-associate the small cap space with that kind of risk and that kind of maybe opportunity. But in fact, there's just hundreds of excellent companies that have a long-term possibility.
I mentioned in my introduction to you, Chuck, that the Pennsylvania Mutual Fund has, beaten the market and the small cap universe since inception in 1972. And it's also, if you just look about any multi-year period since then as well, that it's also been beating the market, which, is really extraordinary. And again, with lower volatility. How do you explain that?
We've stuck to the principles we've just talked about. There's just wonderful possibilities in the small cap space. So it is a forever area. I don't think it's something that people should come and go with. Oddly, if you just stuck with small cap stocks, you would do fine over most time periods, 3, 5, 10-year periods. You would have better returns with higher volatility, better returns than large cap. So there's a continuity to it. Now, we were going to do that anyway, but now if you look at history, there's a reason why people should have, 10, 12% of their money in small caps all the time.
Mm-hmm. So why so little? I mean, why not more? Because I did look at the figures, and in fact, small caps have outperformed large caps during many cycles. Obviously, we are not in one of those cycles now, or have not been for the last 10 years. But then why not, have a higher percentage in small caps? I'm assuming you personally probably do.
The answer is volatility scares people away, and they're interested in, in the FANG world, they're interested in brands that they've gone familiar with,
right?
Amazon, Google, et cetera. So there's an attraction to that, the land of the familiar, which keeps these things going. But I'm completely happy to stick to this space, forever.
Run us through how you decide to invest in a company, and give us an example of one of the companies in your portfolio and what drew you to it.
In the particular portfolio that I've been active with, Penn Mutual, and something we called Premier, I love extremely long-term investing, things we could own potentially forever. So it starts with an idea that potentially we're buying the whole company. We're going to close the door and let the years go by and own it for a long time. So we start with that attitude, which means we're going to spend time on, okay, what could cause this company to prosper way out there? The word I like to use is identifying those features that are durable. Now, in today's world, you can do that by identifying them, at the level of what you see in the company. But then it's important to go out and talk to customers, talk to ex-employees, talk to suppliers, et cetera. In other words, do the work in the ecosystem of the company, not just on the numbers. Of course, the numbers are good today. That's what drove our attention to it. But what you're trying to think about is, will they be good tomorrow, 5 years from now, 3 years? So that focus, that sort of time arbitrage of looking way out, for me is the most interesting part of investing. I'll give you an example of a company we like a lot to this day. It has a brand. It's something you would know and we all know. Morningstar, the publisher of lots of commentary. It started with a competitor to Lipper many years ago, when Lipper was king of that land, and Morningstar has completely taken that over for good reason. They did a better job. but they've evolved into be a data bank for so many people in so many ways. They have moved that knowledge into even a more interesting area, asset management. And so you have, I believe, extremely durable features, which allows us to continue holding it for way out.
Management obviously is really important in a company that you want to invest in, but also the ownership of management of the shares of a company are important as well, right? And why is that such a key characteristic for you?
Well, you want everything aligned. You want the ownership to be aligned. Now, that could be from prior ownership. Maybe it's still in the founder category.
Right.
In the case of Morningstar, that is true. But in many companies, the ownership has shifted over time. So it's up to the board to make certain they have aligned interests. So we are very carefully look at those forms of ownership. They could be direct ownership. It could be all sorts of compensation plans that have the same effect as ownership. But the proxy governance issues are critical to making good decisions. So yes, we absolutely discuss that, and that is a conversation before we undertake owning something for a long time. We want to make certain it's all fits in. So you're right.
How do you differentiate between the owners who really are in there for the long haul, owning with shares in the company, and those who are basically incentivized to get really good short-term earnings results, and then when they leave in 5 years or whatever, they basically cash out? I mean, how do you tell the difference?
That is tricky stuff.
Yeah.
And you are 100% right. An issue that comes in our space is companies selling out to a private equity firm. That happens to us routinely.
Do you see any change in that phenomenon, especially with interest rates going up and a lot of private equity firms, the companies they've invested in are very highly leveraged now, which of course would be a no-no for you anyhow, so you probably wouldn't be invested in those companies. But are you seeing any change at all because of the rapid rise in interest rates that are affecting private equity financing?
Well, I think you're right. The change, the rates that went up from 0 to 6 in the fastest period of time ever,
right?
Like a year. And so that, honestly, I think it's a trend towards normalization, which will benefit the kinds of companies we invest in who are much more solid, and they have the financial flexibility to be the buyer.
I seem to remember reading somewhere that you did not own Silicon Valley Bank, but I think that you owned the bank that took over Silicon Valley Bank after it went under. Am I right?
You are right. We did. I mean, this is in the luck department, Consuelo. Okay, we owned First Citizens,
right,
which was the bidder of Silicon Valley, and they were highly qualified. The reason we owned them is they were a great bank. Did we have any clue they would be advantaged in the world by virtue of Silicon Valley and a couple other banks, going out? No. But wow, did they get a deal. The First Citizens took all the assets, all the relationships. Their earning power virtually doubled overnight.
Wow.
And the stock is up. So while all the bank stocks were going, and Penn Mutual had a chunk of it from 5-10 years ago. So all the other banks that were going down, all banks went down 25% approximately in that couple month period. First Citizen doubled. So yes, that helped the short-term results. It was not a planned, outcome, but it was a wonderful outcome.
What are some of your favorite areas?
We have this wonderful world called industrials, which are basically B2B or service companies, et cetera. It's kind of misnomer to call it industrial. But it's a huge area. We're always swimming in that pond. We look at virtually everything in the financial areas. We look at everything, really, I look at everything but banks. I'm not looking for the perfect banks, but I will do it. But in general, outside of banks, in the financial area, I love other money managers. Artisan Partners, I love. And we've
That's
been
kind of a boutique, right? Artisan Partners?
But they're very differentiated. I like how they run their business, et cetera. And, they too would benefit by a higher stock market in small cap, et cetera. So I like things in our space. We've always liked boutique financial firms like Lazard. We've owned it for a long time. It pays out all of its earnings. They are extraordinary company historically with huge total returns, but you have to count the dividends.
What's one of the best investments you've made recently, or that you own currently?
Well, a stock I like a lot is in the financial sector called Air Lease. They lease airlines for the world. It's a global company, but they operate in such a differentiated way. They really are consultants.
Yes.
Every single nation has airlines. Now, all of the airline manufacturing is basically here or in Europe. So the leasing or the financing of airlines is a critical business. And these guys are the smartest people in the world with extremely strong relationships that I believe will benefit them forever.
So how do you get through the most challenging periods? And you mentioned the Nifty 50, and you mentioned you didn't invest in the FANG stocks, but how do you get through those periods when shareholders are bailing on you, which has happened? It happens to every portfolio manager.
Absolutely. Oh, that is the $64 question. We're in a period of low returns in small cap. I think we talked about the current returns of 3.5% for 5 years. That, by the way, 100% of the times has delivered very strong next 5-year returns, 100% of the time. And that's where we are today. Current 5-year returns, 3.5%, under 5%. These statistics are pretty powerful when you can use the word 100% of the time.
If there's one investment for a long-term diversified portfolio that we should all own some of, is there one investment that you would recommend?
Well, the stock I just mentioned, Air Lease, would be my favorite stock. And Air Lease is this fascinating, I would call it a merchant bank, because it goes and takes risks in the pipeline for how you order planes. It will get in line and be early in line. They will advantage themselves and their clients by taking some different posture. They're not a pure leasing. They operate as a money manager. They actually do leasing for other investment groups in the leasing world. So it is my favorite stock.
Chuck Royce, thank you so much for joining us once again on Wealth Track. Congratulations on 50 years of Royce and 50 plus years of running Pennsylvania Mutual Fund. It's quite a track record. Thanks, Chuck.
Thank you, Consuelo. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is one of Wealth Track's enduring themes. Once you have figured out what your exposure to stocks should be as a percentage of your portfolio, the action point is stay invested in stocks. On past episodes of Wealth Track, we have shared compelling evidence that even missing a few of the best days of each decade since 1930 can lead to huge underperformance. It turns out the same is true with small caps. Royce looked at returns of the Russell 2000 during the first 12 months of recovery rallies from 1978 until now. Staying invested for the full 12 months of the market's recovery meant average returns of nearly 65%. Miss a month and the returns drop to 42%. Miss 3 months and your returns are halved to 31%. You get the drift. Going in and out of the market really doesn't work. Staying invested, even in more volatile small cap stocks, does. Next week, we explore tackling climate change through investing with portfolio manager Lucas White, who launched GMO's Climate Change Fund in 2017, inspired by his boss, investment legend and passionate climate change mitigation advocate Jeremy Grantham. In this week's extra feature, Chuck Royce discusses the thrill of investing 60 years in, why he still loves it. Please follow us on Facebook, Twitter, and our YouTube channel. Thank you for watching. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.